Kevin, how you doing, man?
Very good, Ryan. Happy to be here with you.
So we're wrapping up 2020. By the time this goes out, we'll be off into 2021, hopefully coming up with some sort of those projections that we all send out of the companies that we work with. Let's see if we can actually hit it on the mark.
It will be good to have 2020 in the rearview mirror. It was a mess for a whole lot of reasons.
So for the listeners, I'm going to connect a couple dots. You and I'm trying to even think who introduced us. I've just crazy small world, man. Like with you and I, we know a lot of the same online entrepreneurs. And then Arvid, who literally was just on the show, he finally got to the end. And I didn't even know it till the end. And he was like, yeah, I sold the SureSwift. And I'm like, shut up. I was like, Kevin? No shit. I just had lunch with him. So I'm just pumped because you got a super interesting background. And for the listeners, I've talked about in our 5 principles, principle 3 is about exit options. And it's just about understanding them. And one of them is an acquisition entrepreneur. One of them is a strategic acquirer. And then one of them is a private equity. And you are a business buyer and you came at it from kind of a couple of those different angles. And I'd love to have the listeners hear your background of how you guys started the business, what your approach is with the first phase. And then you and I were just talking before we hit record, how you're actually getting to professional investment and raising a fund. And so let's just, who are you and how the heck did you get to where you are today? And then we can unpack it.
Yeah, well, let me start by saying of those exit options, I guess we would technically qualify as private equity. But a friend of mine said, and I like to just steal it, he has a similar business in the offline space. His name's Brent Beshore.
Brent's been on the show.
Oh, he has? Okay, so I figured you knew Brent. He said at one point, calling us private equity is like calling an ostrich a bird. While technically correct, it doesn't really fit the spirit of the word. So there's a lot of things about SureSwift that are very different than private equity. We have more of a permanent capital structure. We don't buy with an intent to flip and sell businesses. We don't have a hold period for our fund, so we can get into some of those details. But I like to think of us more as a holding company. So maybe you could add that as a fourth option to your exit options. But that's what I want your listeners to think of when they're envisioning SureSwift. So getting into it, I don't know that my background is all that interesting. I spent 15 years in corporate America working for a very large software company and did a little bit of everything at that company, from sales to sales leadership to operations, managed development teams, managed big client relationships. Company was Cerner, and it was a really fast, I don't know what their growth is over the last 6 years, but I was there from 2000 to 2015, and it was growing
screaming
really fast, which just created opportunity. Like if you performed, you got given the next job and the next job and the next job until you screwed up. And fortunately, I performed more often than I screwed up. So, and after 15 years, along the way, I got an MBA nights and weekends just because to beef up my business knowledge, because in college, I wanted to be a high school math teacher. So I got
no kidding.
Yeah, I got a math and secondary ed double major, and actually was a high school math teacher for 1 year before joining Cerner. And I just realized I didn't love it enough to, sign up for a teacher's salary for the rest of my life. So I wanted to try something different. At any rate, I got into the corporate world and realized there's a lot of stuff that I don't know about business. So went and did the MBA, and I thought that would, make me more valuable. But the two things about the MBA are, one, I actually learned more just from working at Cerner about business than being in a classroom. But the more important thing, I read all these case studies of entrepreneurs who built just giant, amazing businesses. And I was sort of scratched below the surface and realized these aren't comic book superheroes. They're just normal men and women who maybe had a good idea, or maybe worked a little bit harder than average, or were maybe a little bit, smarter than average. And I'm like, well, why can't I do that? So I'd always had this dream or desire to own my own business, and I just never had the right idea. And so, fast forward to sort of the end of that part of the story, been at Cerner for 15 years. I knew the next 10-year career trajectory, and I was becoming less and less interested in it. Not because I didn't love the company, it just was kind of like started to get a little boring, and I didn't want to do that for the rest of my life. And then, a friend who ended up being my co-founder approached me with the idea of, hey, why don't we just buy other people's businesses that are profitable and, we'll run them. Like, just that simple. Like, that's what private equity is, if you boil it down to two sentences. And, after a lot of thinking and talking and, analyzing what that might look like, I was like, yeah, this fits. I get to run it, but because we're only buying profitable businesses, it's way lower risk than a lot of startups. So, there's a million details in the middle of that, but that's kind of what was the genesis of SureSwift.
So, and what I think is super interesting as far as it like relates to buyers and sellers of companies, one is that like, I'm curious in like how you guys landed on kind of your holding company structure, because like when I look at like the 5 categories of exit options that we have, they're kind of like categories of like dogs, cats, like there's a bunch, right? So like a family office could invest in a private equity firm, or they could go buy the company themselves, right? So like, as an acquisition entrepreneur, Walker Dybel's terminology in his world, it's like, okay, someone in like your situation, like Minnesota here, we got 3M, we got all these public companies. So someone could save up, a few $100,000, go get an SBA loan and go buy a company. So you decided not to do that. That would be kind of the acquisition entrepreneur. And then the private equity is you raise a fund from investors to go deploy the money. You're kind of like in between there. And so like, how did you decide to do what you did instead of just raise, or take a little bit of your own money and buy a company with an SBA loan? Or like, what was the thought process behind the holding company?
So going back in time, the thought process was, it was, me and that original co-founder, let's just pool our own capital and test the idea. There wasn't really anything I wasn't going to take out a loan to go do it because we didn't need to. And I would rather, test the idea with my own money than put, risk, losing a house because something went sideways. And so we just started small. And in terms of like the long hold period, it was really about the market that we're in. So we haven't really touched on this, but I said we were going to buy online profitable businesses. I don't know if I mentioned the online part earlier. In that space where we started, which was, candidly, relatively tiny checks. Like the first business we bought, I think, was for $50,000. Yeah, the range has gone way up since.
Couple more zeros these days, right?
Yeah, right. We're buying businesses that are, inherently more risky than a brick and mortar business. Like there are no assets to be auctioned off if it, you wanted to break it up for parts. There's no real estate. And so because they are inherently more risky, they trade at sometimes multiples as low as 2 times trailing 12 profits. So I looked at that and I'm like, okay, well, I'd love to be a buyer in that space because all I have to do is not screw it up. And in 2 years, I've got my money back. Sweet. And I still own a profitable asset. I don't like being a seller in that space because why would I sell an asset when I could just hold it for 2 more years and still have all that money? Now, as our check size has gone up, so has the multiples, but they kind of
the concept
top out at between the 3 to 5x trailing 12 profit range, right? So, and EBITDA for your listeners. So, love being a buyer in that space. Not crazy about being a seller in that space. So that is why we sort of naturally adopted this buy and hold strategy. And I do want to emphasize, like buy and hold is a strategy for us. It's not a religion. We have divested in some businesses, including that first one that we bought for $50,000 because it just like, they don't fit what we're doing anymore. Over the period of 5.5 years, we've evolved to being squarely focused on software as a service businesses. And we had some businesses early on that were content or membership based. And so that's kind of what has driven the strategy. Now, along the way, we did take on some debt just to extend our runway and juice the returns. So I'm not anti-debt, especially in today's, markets. But yeah, the whole SBA loan, nothing against people who do that. I just worry that a lot of businesses are going to go under because they're going to be overweighted with debt. And if it, takes a downturn, you can't service the loan. And I'm not crazy about a lot of like brokers in this space. And the ecosystem is just promoting that. And I love that as a means to entrepreneurship. And I worry that somebody, especially somebody who's never been an operator before, decides they want to be an entrepreneur and they buy somebody else's business with other people's money, and just things can go wrong really easily in that scenario.
Well, and I think it's super interesting, Kevin, because like, you know, the point of the third principle being exit options, just to understand how you could eventually transition or liquidate some of your ownership. And like, you know, I've always said, like, you know, you got a lot of these search funds out there, like, and people don't know that are, you know, sellers. They don't know the difference between you guys and some individual Sally or Joe that's willing to take out an SBM. Like, so therefore what they're willing to accept for price and terms with what the person's capabilities of running that business after close is so huge of a spectrum that they have to do almost just as much due diligence on the buyers than they do.
Yeah. And one of the reasons why I love your podcast is that it, you know, you're educating people on all of these things. And I think, you know, a good business owner should be thinking exit options way before they, or even if they never intend to sell. You just need to understand the ecosystem and understand what that looks like so that when you are ready to sell, and sometimes our timing doesn't end up being the timing that we think it's going to be, right? So you need to be prepared for, you know, anything that could come your way in business, and an exit is one of those things you need to prepare for. And yeah, I totally agree. Like, you know, the last price is one of 100 things you need to worry about when approaching an exit. And the other 99 are just as important as price.
So, I'm curious, and I think the listeners should be curious too. If you went from being a software sales rep at a very large software conglomerate to buying companies, so like, where in the hell did you learn valuations? You said TTM, trailing 12 months, deal structure. Like, so the education that the listeners are tuning in for that own a company are also like, how did you get that knowledge? And then how did you like start to apply that? And then how did like, this is all tied into one question of like this lack of valuation and deal structure and like understanding it from the seller and owner's perspective. How did you get it? And then how does that translate? And what's your observations as far as the market's understanding a level of education?
A lot of questions there. Let me try to take them one at a time. So
sorry about that.
During my corporate experience, I was fortunate enough to lead one acquisition that was successful. So I saw kind of the big picture and learned some of the things of like what to think about and how valuations are created at that level, which is astronomically different than what I'm doing. Like there were so many, you know, bankers and lawyers involved, you know, it was silly, but it at least was a swing at the bat. Right. And then before I quit my job and committed to do this, I did a ton of research. And you know, it's easy to say, well, let's go find online businesses and buy them. But like, okay, well, what does that? And,
what does that mean?
Through that research, I found there are brokers that deal exclusively in this space. And that may have been who I think maybe you had Mark Doust on your podcast.
Yeah, years and years ago, Mark. Yeah. And then even FE International, Thomas Smale was on here for.
Yeah, so I know both of those guys very well. I bought businesses from both of them. And that was the light bulb moment for me, because I'm like, okay, you know, we can buy online businesses. What do they look like? What is the profitability of some of these things? What types of businesses are, because I was in software, but it's almost like a different industry, like a big, you know, for some context, when I left Cerner, it was doing $5 billion a year in revenue and had 20,000 people around the world working there. Right. So now I'm trying to study online businesses that, you know, it could be a company of one, and it might be passive income for that one person. Right. So it's, you know, it's very different. But as I studied it, I uncovered Quiet Light and FE International and a group called Digital Exits. And there was like 30 different brokers. And the more I looked, the more I found. And I'm like, okay, there is a robust secondary market for these businesses. And I don't have to just like open a phone book and hope to find somebody that has an online business and hope that they're ready to sell. And it was those brokers early on just getting a whole bunch of reps. You know, I got on their email list and you get a new prospectus, you know, often multiple times a day, and just reading and studying and realizing there is a kind of a range in there of like, this is what a reasonable asking price would be. And these types of businesses have this different nuance. And these are the things that, so I learned from those sort of experts in the field, because all they do is turn out businesses. Not all they do, that undersells the difficulty of being a broker, but that was where I did a whole lot of learning really early. And then the biggest learnings happen when you actually start, taking punches and, doing these acquisitions and figuring out all the legal stuff and escrow and how to transition a business, and being burned once or twice are always good lessons. Making mistakes are always good lessons. And that's really, just like working at CERN taught me more about business than sitting in a classroom and learning about business. I learned a lot just from reading these prospectuses from brokers, but I learned a whole lot more from as of recording, we've acquired 38 businesses in 5 years. So, a lot of those went well, some of those did not, and actually learned as much from the failures as I did from the successes.
So 38 businesses in 5 years. There's obviously a lot of lessons that you've learned. You could probably go teach the MBAs at this point, right? So, when you maybe there's a couple questions that I have is now that you're at, before we get into what you guys are doing now and how you've upped your game as far as raising a fund, this pool of capital, I'm curious on how did you fund these? And trying to think of what's the best sequence here is first, how did you fund them, and how did did you fund them with, as you continue to acquire them, you use the cash flow to buy the next one, or what was the process? And then is it just you and your other co-founder? What's the ownership?
That's part of the story. Yeah. So it was me and the co-founder, our own capital. I think we did 5 or 6 deals that were in the low 6-figure range, and just to learn, can Kevin find good deals? Yes. Okay. Check. Can we close those? And can Kevin operate them? Yes. Check. And can I build a small team to manage these things so I can continue working on acquisitions and not get bogged down in the day-to-day operations of the business? Yes. Check. And as I get more, I'm seeing more deals, I'm building good relationships with these brokers, not just on their email list. And we're starting to see more deals that are bigger that we didn't have the capital to go execute on. And so we brought in 3 other partners and sort of recapitalized the business with more money, but just from, it's still 5 humans putting in personal money to go fund this thing. And so we start doing more and bigger deals. And
clarification on that part. So when you recapitalize the business, for the listeners that may or may not understand how that would work. So I'm assuming did you guys put a value on the whole portfolio of companies and then ask for equity from the other partners, or what was the way of understanding equity, and how do you divvy that up?
Because the early portfolio wasn't all that big, we went from, instead of I own 50% of the business, I own 20% because there's 4 other people, but I didn't put in any more money. They all put in large sums of money. I just committed to them. This is all I'm going to do for the foreseeable future, and I'm going to run it.
Okay.
So, and then along the way, that was Black Friday of 2015. So big milestones tied to holidays. I actually quit my job on July 4th, 2015, which I call it my Independence Day from corporate America. And then that Black Friday, we signed the new shareholder agreement and had new capital, which was immediately deployed on, some of it was immediately deployed on a couple of deals later that year. And then about midway through 2016, we had now a robust portfolio with a meaningful P&L, meaningful balance sheet. And I went and secured some senior debt and some mezzanine debt just to sort of extend that runway, which got us through, got us to just about Christmas of 2017. And then we continue to see more deals, and everybody's super excited. And so my partners and I said, all right, well, let's put more money of our own back into the business so we can just keep funding. And then fast forward to today, as of reporting, we are about to close our first fund from outside investors. So, the great thing about our business is that it can scale almost infinitely. Once you start digging in, and it's probably strange for your listeners to hear this, if you're not in this space, I know you understand it, and you interviewed Arvid, and then he's like a prototypical bootstrap software entrepreneur. But it's this kind of odd segment of the worldwide economy that is massive, and yet most people don't even know that it exists.
It's so true, man. It's
right?
So true.
And so the reason I bring that up is like, we could, if we had enough money and the operational capabilities, we could go acquire 200 businesses in a year. Like, I don't think that'd be a good idea, but we could do it. And so, if our business just requires like ongoing addition of capital, if we want to continue to scale and grow, which we do.
So, okay. And I want to kind of like cover some of the stuff in the current holdings company structure. And then we can talk about raising money and how that's different and how, because again, I think it's important for everybody to understand just the difference of these structures. But going back to like when you said, you went out and you found some senior debt, some mezzanine debt to extend your runway. One of the things that I've realized is kind of one of my missions, Kevin, is like this ability for people like your and I's discussion to have these conversations around capital and what that means. Because business owners, they end up hitting these thresholds, and a lot of it has to do with capital and then strategy, realistically. And so they hit their own ceiling from capital and strategy, and then they end up either continuing to maintain that flat line or selling it. And so when you talk about like, so you got U5 and you've got this pool of companies, revenue, you got cash flow. Did you then go when you say did you put some debt on the overall structure so that way you were able to then, it's almost like refinancing, right? For the people that aren't really cash out refinancing, so you can then take that money and then go buy more companies, right?
That's a very good analogy. And when we did it, it was pretty, I'm a big spreadsheet guy. So I built up a spreadsheet and said, okay, if we finish deploying the capital that we've already put in as a partnership group and things continue to go well, what does that ongoing cash flow look like? And we would be able to continue to fund acquisitions through cash from operations. It just would have been way less interesting. It would have been a very slow and steady pace that frankly would not have, given me the income and lifestyle that I wanted. I'm just not that patient.
Yep.
So yeah, that's exactly right. We secured the debt against the existing portfolio and convinced the banks, and it did require some convincing because just like most of the world doesn't know that this segment of the economy existed, our bankers had no idea what I was talking about. Like I had to define SaaS for them upon
and I'm sure the bankers are going, all right, Kevin, so where's your stuff that we can take back if you fail?
Tell me about the assets of these businesses.
It's called a domain.
An email list has some value. Let's talk about that. Yeah, no, it was we joke, but it was a legitimately, like, I had to educate these people on like what it looks like. And I'm the guy who just learned that this like thing even existed a year and a half ago. So yeah, I feel like I should say also, like, one of your questions, like, how did you decide on this strategy or that thing? To be honest, Ryan, like every month I feel like I'm learning the next thing to get me through the next 6 months. Like we're making it up as we go along. And I like saying that out loud because I feel like everybody feels that, but people are hesitant to just say that out loud. We're all just like dumb cave people wandering around in the wilderness trying to figure shit out. And I'm one of those people. So yeah, how to approach it.
Well, and it's so interesting. Just on a little commentary on that anecdote on that is, the private equity world. I mean, because they're not public, they naturally do not have the worldwide human race constantly analyzing their numbers. And so like, I mean, I know multi-billion-dollar funds where they're like, when they're reporting to their investors, they're just like, well, we think it's worth this.
Yeah.
It's like, oh man, they don't have analysts that are like, second guessing their numbers.
Yeah. I'm in the middle of reading The King of Capital. It's
the best book ever, dude.
Steve Schwartzman from Blackstone. And it is mind blowing the amount of money that they just like burned on bad deals. And like, I feel bad because I at one point paid $250K for a business that didn't go quite as planned, but it's still profitable. And Schwartzman is like throwing $2 billion into a furnace. Yeah. And luckily they had other deals that, had a 20x return. So like the good outweighs the bad. I'm like, dang, that's me just on a tiny scale. But like this guy has one of the arguably one of the biggest and best private equity firms ever. And they made so many giant, big, bad mistakes. And in hindsight, it was like, man, I feel like you should have seen that coming, So like, that's one of the reasons why I love that book, because it makes me feel so much better about the tiny mistakes that I'm making on a relative basis.
Well, I think it's important. It's an important part of the story because how transparent you are with that goes back to, like even like this, going back to the concept of recapitalizing SureSwift and making sure that you can use that better. It's all about this capital deployment and allocation. So like, when you think about your strategy, any business owner could literally do what you just did, right? Like you could go out and take a loan out in your own company and use that cash to continue to reinvest it. Most people don't understand what we're talking about, so they don't do it. So when you going back to your part of the story, so you now have more capital because you took on some debt, you got your partners. How did you use it as far, what are the different types of deal structures that you see? And like, so I just did this interview, and some of the context behind the question is there's the deal price. So like there's the price of the deal, the enterprise value that you're willing to pay. And then there's the deal structure, right? So like, how are you going about to make sure that you're using your capital correctly so that way you have the ability to reinvest in the things that you need to grow the value? Like what was your overall strategy for looking and assessing deals and then pulling the trigger?
So as far as growing the portfolio after we've acquired is like rule number one, the business has to be profitable. And then we sort of build based on the profits of each portfolio company. Not that we can't share resources and funnel people or money to other spots, but we don't want to take a loan to grow a business. Like the profits of that business should grow that business. So like set that aside.
Okay.
And then deal structure, partly because this is the way the market works in our space, and partly because I like to keep things simple, both for me and sellers. We try to keep deal structure fairly simple. There is the sale price, and usually there is a majority of that cash is just handed over at closing once we do the transition, and then usually there's something of a holdback or an earn out over we kind of settle on a 6-month period where that's enough time for us to get our arms around the business, get enough help from the seller to where we're capable of running it. Longer than 6 months, it's like shame on us if we can't get our act together and replace that founder in 6 months. But shorter than that, like we've done deals where it was just a 3-month transition period because the founder had like a full-time job and other commitments and they just didn't have the time. And that's really pretty quick to go through the mechanics of transition and get settled and be able to like take care of customers and take care of marketing of the business. So that's kind of what we do. And that's fairly typical in this space. We also, I'm thinking before I say it out loud to make sure I don't misstate it. And I think it's always been 100% buyout. So there's other, you could do a majority buyout, minority. That's just not our style. Like we love finding people or they find us when they're, and I mentioned all the brokers that we dealt with in the beginning. Most common now is that we reach out to a founder and say, hey, I dig your business. When you're ready to sell, you call me. And they do. Like that's how we found Arvid and his wife, Danielle, wife and co-founder. She's the CEO and he was the technical guy. I just emailed Danielle and I was like, your business looks really awesome. By the way, I'm Kevin. I buy businesses like yours if you're ever interested in selling. And like, I think it was 3 months later, we owned it. And I don't know if that jives with what he
and he even said that like he circumvented the brokers and his one deal was all cash. I mean, I don't know exactly what the structure was, but I mean, whether it was all or mainly cash, I mean, it was.
Yeah, like individual deals, it's confidential, so we don't disclose specifics. But yeah, it was cash with a bit of a holdback to make sure we had the business, arms around
not 100% earn out and you're like trailing them along or anything like that. And
yeah, it worked out great.
It's interesting too, because I interviewed a family office and we were talking about like a lot of family offices that do direct investments of purchases like that. They don't do any minority, like they don't allow people to roll back in because they're like, if we have an indefinite hold period, all of a sudden it's against our interest because we're growing value and we're going to have to pay more for that percentage at some point versus a PE firm where they'll typically have a date that they have to liquidate. So everybody's moving towards a liquidation event. So it's
right. And that's what I love the buy and hold strategy for a lot of those reasons, but it doesn't make sense for a seller to roll. And, you don't have to make decisions another mind-blowing thing about King of Capital. Like they own some companies for less than a year, and just financial engineering, strip expenses, and which I know that's the playbook, but I didn't think you could do it in a year.
Crazy, isn't it, man?
So and it's just that's fine. You're making a bunch of people a lot of money, but I'm more interested in like long-term. This is my last job. I'm about to turn 44. I'm done. I'm doing this until I don't want to work anymore. And so I'm more interested in, the whole notion of playing long games with long-term thinking people. And the businesses that I own, I want to make sure they have long-term sustainability, just healthy growth. It could be fast growth, but I want it to be healthy and sustainable.
So you just said a couple of words that I love using: sustainable, predictable, and transferable cash flow. And so when you think about like these companies, the 38 companies that you've owned, like give us a peer into your mindset of once you, like when you're vetting out a deal and then once you acquire it, like what's the strategy? Because you've got a long period, right? So it's not the short-term financial engineering, but like what thought process or mindset do you and your partners have, Kevin, that are like how to grow more value? Because that's the premise of this podcast, of owners of any kind of company. You can do this, or even people like yourself. Like, what are you doing that's working to make sure that like when you purchase that company, you've got the ability to actually grow it the right way?
Yeah, well, one of the things that has worked is acquisitions are very much a team sport. So it's me and my whole leadership team that assess a business. We've got a dedicated growth team that all they think about is growing the portfolio. They weigh in on acquisitions. We've got technical experts, either based on the tech stack that a business sits on or the platform it's on, that which avoids mistakes, but it also uncovers growth opportunities. And a simple way to think of it, Ryan, is all of the businesses we acquire are small teams. Often it's a technical founder, somebody who wrote all the code, him or herself. They hire a few people to help once the business gets big enough to support it. And the smartest ones know to start replacing themselves. So like the less they do on the day-to-day, that's that transferable cash flow that you're talking about. Where if I'm working full-time on the business, then the seller has to, or the buyer has to replace a full-time person with a pretty unique skill set, and that's expensive.
Yep.
So those are some of the, when it works well, how do I say this in a simple way? I've got immense respect for people like Arvid, and there's dozens of others that we bought businesses from that have built something out of nothing. Immense respect. And at the same time, shame on us if with 80 people around the world with all this technical expertise and all of these experiences under our belt of acquiring and operating 38 companies, if we can't take a business that's got a solo founder trying to figure it all out, him or herself, and if we can't do at least as well as they're doing, and hopefully a little bit better, then we're doing something wrong.
Yeah.
You know what I mean? And so that's like the basic premise of growth. And then looking backward, it's easier to grow a company after you buy it if it's growing before you buy it. Like we've tried. There's a little pearl of wisdom for your listeners, and I trademark that for Kevin McArdle. But we've tried the turnaround, and there's a lot of people raising funds out there to buy failed VC companies and strip away all the expenses, and we're going to turn around and make it profitable. And good luck to those folks, because that sounds really hard. I've kind of tried that before. It's really hard. You can get it really cheap, but it's hard to do. And we bought businesses that were flat because we knew, and the sellers told us, we've kind of been ignoring this business because we're working on this other business that's growing. Perfectly reasonable. And we're like, well, that's flat, but we can make it grow. And turns out that's hard. It might be flat for a reason. And then we bought businesses that are, growing 50 to 100% year over year. And turns out those are pretty easy to continue growing 50 to 100% year over year. And you can even bend the curve upward a little bit. But it just comes back down to like, we have scale, we've got expertise like talent in the room. And we also have the experience of doing this a whole bunch of times and learning what works and what doesn't work. And we're just very much systems and process oriented, so that, another person that and that your listeners will know is Robert Smith from Vista Equity. Like they always talk about their 110 standard operating procedures. And I just tried to steal that idea and say, okay, figure out what works, write it down, and do it across the whole portfolio, and learn something new, and then write that one down, and just keep leveling up our expertise.
Got it. So then there's, like, when you buy the business and then you say, okay, what are we going to do now? How do you leverage that team? How do you leverage that experience? There was a concept I introduced into my partner and I's podcast called annual income versus long-term value creation. This kind of theory that, like, we've kind of identified of, like, most owners are solving for annual income, sucking the distributions out, sucking, the pay from their salary, and they're not reinvesting. So there's this thing called burning the J curve, burning EBITDA, right? So, like, but the goal is it's just reinvesting back. You're reinvesting the cash flow back into the business. How are you identifying where to put that money back in? Like, what strategies that grow value, not just, vanity metrics of revenue or email subscribers or whatever the hell it might be? I mean, is there like some way that you're using a lens to figure out how to deploy that money?
Yeah, my vanity metric is cash flow. And
is that a vanity metric if it's the only thing that matters?
Yeah, I don't know. Yeah, I mean, we don't talk about it publicly, so it's just vanity, me looking in the mirror. But the simple way to answer your question, Ryan, is that the largest expense for any of these businesses is people. And so, if we take a business that's doing $30K a month in revenue, and it grows to be $60K a month in revenue, that's because we've either, doubled the customer base or raised prices or some combination of the two. And so we're probably going to need to add team to support that 2x customer base. We're going to have to add some technical infrastructure and scale up the tech to support a doubling of the customer base. But you don't have to double the expenses to support that. So margins expand. Another thing that we do is paid advertising. So Google Ads or AdWords, some of your listeners will be familiar with. We test that, and if it works, like if we can put $1 into that machine and get $2 back, we'll do that all day. But there is a point of, like, diminishing returns where, like, you just spending more money doesn't, and end up you put $1 in the machine and $1 comes back. Well, okay, let's halt there.
Yep.
So we're very conscious, business by business, to making sure we have the right team on the ground to support the business as it is. We know in many cases, if we add team members, that increases growth, et cetera, et cetera. But that, we joke that there's no assets, there's no hard assets to these businesses. That they're also not that capital intensive. You don't need a whole bunch of money to fuel growth. So I don't know if that answers your question.
Totally. Yeah, absolutely did. And, because the long-term play is that you're growing the value of this portfolio of companies, right? So the overall, I don't know if you're doing some sort of like multiple arbitrage where you're buying them on the 2 to 3, not only are you growing, so the multiple is going to expand just by the normal growth of that individual asset, but I don't know if you're kind of assessing it where, like, the whole thing together is worth a 7x or something like that.
Yeah. So there are some public company examples of this, like Roper Technologies would be one. Constellation Software is the most, like, direct comparable to what we're doing, because all they do is acquire software companies. Now, they've been doing it for 25 years and are worth, like, I don't know, $17 billion. So I don't want to, like, get out over my skis too much on that comparison. But, they trade at a multiple that is way higher than they're buying at. And so we're private. We're thrilled to remain private for a very long time. But there is that notion of, I'll give you a specific example. We bought a business for, I think it was doing $50K a month in revenue. So that would translate to, $600K a year. And so that is in this multiple range that I'm talking. And it's a beautiful, wonderful software business. It was growing. Founder was amazing, super profitable. So it commanded like a, high-ish multiple in our range. And now it is doing almost $200,000 a month in revenue. So, and by our forecast has it at like 240 by February, March. So it's been a great result for us. And 240 is important because that means it's $3 million a year in revenue. You start breaking through some of those thresholds, particularly $5 million a year in revenue. Now you're talking about a multiple of revenue that you're getting. And now you're getting probably interest from bigger PE firms, or you're getting interest from strategic acquired, back to your like exit options.
Yep.
So there absolutely is an arbitrage play there where we're buying at a, 3 to 5x multiple of profits. Can we sell at a, 5 to 7x multiple of revenue? Like that would be a home run investment. And that's why I say buy and hold as a business strategy is not a religion.
Right.
If we can if somebody makes us an offer we can't refuse, we're going to do that deal. We assess our whole portfolio once a quarter and kind of categorize things, say like, are we investing in this? Are we harvesting cash flow? Should we tee this up for a sale? Et cetera. And that's just part of the normal. Again, that's one of our processes that we go through every quarter as a team.
So this is an interesting time, I think, as we bridge into why you decided to raise some capital. But before I do that, I'm curious I'm just picturing myself in your position where you got 38 companies where I don't know how many you hold right now, but you have cash flow, because I know you said that's your vanity metric. How was there a personal factor into this of like you five want to tap into those distributions because you've got your salaries, but if you're constantly reinvesting, when you got 5 partners, one of the biggest challenges I see with any partnerships or families is like, you have to agree on how much you're going to pay yourselves versus reinvest back in. And most people don't even agree on that because they don't agree on the long-term strategy. So like, are you just rolling all the money back in, or is there some sort of agreement of like when and how you guys can pull some money out of the business?
It's more about reinvesting and growth. So but to be honest, that has evolved. We started building the portfolio thinking, okay, we'll have all these companies that are just, churning cash. Cause like the profitability of these businesses ranges anywhere. I think the quote unquote worst that we bought, it's still a wonderful business, was 30% margins. And we bought businesses that were effectively, 100% margin. Like it was the owner's time and like almost no expenses. So they are very, they produce a lot of cash. So we thought, all right, we'll just roll these up and like everybody pulls cash out. And then, as I got into it and, my caveman brain started thinking a little bit more, I'm like, well, this money could just fund the next acquisition and the next acquisition. So
addicted.
Like, yeah, I need to pay my mortgage and feed my family. But like after that, and your whole point about don't burn EBITDA, like we are now way more, and for, 4+ years, we've been way more focused on creating enterprise value. That is the goal. And we have a, really healthy partnership group that, usually agrees on things, and when we don't agree, we just talk through it and sort it out. So I'm very fortunate to have partners that are really well aligned on the long-term goals for the business.
So what was the conversation when you guys all, or guys, gals, I don't know what the setup is, but when you all were sitting there and you said like, hey, let's go take other people's money and buy companies now. So
well, it was similar to the debt conversation, right? We were like, okay, this is working and we can keep growing at this pace, but it's working. And so maybe we want to accelerate our growth. And to be honest with you, I was the most hesitant because I knew I've been working with 4, they all happen to be guys. I've been working with 4 guys for, 4+ years at this point. And I'm like, this is working. And if we go take on other investor money, that might feel like I have a boss. And I absolutely do not want to ever feel like I have a boss. And, it might be dozens of bosses if it's all these investors. And it took me a little while to wrap my brain around, like, is that what I want? But, 2 things. Again, I got out a spreadsheet and I'm like, okay, well, we're finally getting like really good at this. And we've narrowed our focus to just look for bootstrapped software as a service businesses. And as we narrowed that focus and I had a more and better team helping with it, we're getting really, really good at this. And again, the spreadsheet says, okay, you could either stop here or we can kind of make a bet on ourselves, reinvest in ourselves, however you want to look at it. And that just requires new and different money at the table. And so that was one thing. I just kind of said, okay, well, I'm a fairly humble yet ambitious person. And so I'm like, if this is going to be my job for the rest of my life, I want it to be, really big, really interesting, create jobs for hundreds of people, not just dozens. And if I want to do that, I need to get over this notion of having some bosses and go out and at least find out if investors would be interested. And so one thing, I just kind of got over it. And then the second thing was I started talking to investors about this concept, and people thought it was really interesting and really cool. And they're like, Kevin, this is amazing. Can I give you some of my money and you just keep doing what you're doing? And had enough conversations and enough, good conversations that I was like, okay, I need to think about this differently. A good friend of mine, like when we're having a discussion about a challenge, he always likes to say, what if the opposite were true? And I was actually talking to him about, okay, if I bring on all these investors, I've got dozens of people and I'm managing their money. And what if they all feel like a boss? And he's like, Kevin, what if the opposite were true? What if it's the best thing that you've ever done? I'm like, okay, well, that might be possible. And it turns out it has been. We now have 50 new people who have trusted us with their money. And about half of them are entrepreneurs themselves and have had either built and sold successful software companies, or they're running successful software companies. So it's just like the network has expanded, the help that I'm getting, everybody's like, call me if you need help. Otherwise, I'm staying out of your way because I got my own stuff to take care of. We also have private equity professionals working for very large firms that you would know the names of that are investing their personal capital in what I'm doing, which is humbling and flattering. And I'm like, if that dude thinks what we're doing is a good idea, it must be a good idea. We have family office professionals who are not the office money, but they're investing their personal capital in what we're doing. And so it's been a great experience. And, deal flow has gotten better because we now have, 50 plus people looking out for us and looking for deals that they would funnel our way. So it was sort of, the fund was born out of not necessity, but ambition. And it's turned out to be, just a home run and helping the business kind of grow to the next level.
So I'm curious, when you're going to these 50 people, what are you saying to them? Like, you know what I mean? Like, because and the reason I want to frame up the question like that, Kevin, is I think that probably encapsulates a lot of your learning lessons too. You know what I mean? Because I'm just another way of saying it. What did you learn? So what are you saying to them? How are you going to use their money? Also, what did you learn that allows you to use their money in a more effective way?
There's typically two ways that it goes. For the kind of prototypical SaaS founder who lives in this sector of the worldwide economy that most people don't understand exists, I say we're buying and holding a portfolio of SaaS companies and sharing resources to help them all grow. And they're like, I get it. What's the minimum? What are the terms? I'm in. Like, they don't have to be explained why it's a good financial model. People that don't live in that world, there's a whole lot of questions about like, what are these businesses? What's to stop Google from, squashing any one of them? Where do you find them? Like, what do you mean a solo founder can be running a business that's making 140 grand a month? That doesn't even make sense. All legitimate questions, questions that I had myself. And so there's kind of those two categories. And in either case, I just kind of explain what we're doing. And I kind of take the approach based on, they're all smart people, but it's a matter of like, how much do you know about what I'm doing? Because you've either done it or you have something similar. The private equity guy, and I would tell you the name of the firm and his name, but I don't think his firm would want the name getting out on a podcast. It was fascinating to me that he works in big, proper private equity, not Blackstone, but like a competitor to Blackstone.
Yeah.
And yet he understood our market, my market, as well as anybody that I've ever come across. Because he just started like learning and pulling on the thread and listening to podcasts and reading blogs. And like, I think he found me. I didn't even find him. Like, he just emailed me. It was like, hey, I like what you're doing. Are you willing to like take investment? And so it's been kind of a weird journey, but the biggest thing I decided to, it's part of how I live my life. It wasn't really about fundraising. I just try to be as like authentic and transparent with people as possible. And I just tell them the truth. And I'm like, ask me anything you want. Hard questions, easy questions. I'm just going to tell you the truth. And if you're into it and you want to invest, awesome. And if you're not, it doesn't work out, that's fine too, because I know it's not for everybody.
So a couple questions on your fund setup and just more structurally. You don't have to give anything confidential unless you're willing to give certain numbers, but like what enterprise value, total enterprise value do you plan to acquire? So if you're going out and buying, like if it's a $2 million business, is it 10 of them or like, so what, and does this up the game of like the size companies that you can acquire? So like overall enterprise value. And then are you taking on debt when you're acquiring these, or like, what's your overall setup and philosophy?
Yeah, we are not publishing the total fund size, but I can tell you we're buying, our target acquisition price is $1 to $5 million in for sale price.
Okay.
And the reason for that is those are very commonly this type of business that we have acquired in the past. We're really good at that. We understand how to operate those things. A $2 million business is, funny enough, like not that much harder to operate than a business you buy for 200K, I have learned. And so why not go a little bit bigger? But in the 5 million isn't a hard cap. But getting much bigger than that, and I love competing in the $1 to $5 million space because I truly believe there is nobody in the world better than SureSwift at acquiring businesses that look bootstrap SaaS businesses that are that size. Nobody in the world. If we started acquiring businesses that were $8 or $10 million, which we could based on the money that we have, we're now competing with more, private equity, like proper private equity.
Yeah, like heavy hitters.
Or strategic, bolt-on acquisitions for corporates, and it's just a different game than I choose to play right now. Yep. And the other reason for that check size is I've committed to investors. You are going to have a very large portfolio of different diversified companies, so that if any one of them has a really bad quarter or bad year, it doesn't disrupt the returns of the fund overall. So I don't mean to dodge your question. It's just
no, I think you answered it. I mean, no, that was super helpful. So then does your fund have do you have like the Brent B. Shore permanent equity model of never selling it? Or like, do you have a date on the calendar that you have to liquidate these or the fund by?
Yeah, we kind of, through discussion, I feel like created I don't know if it's unique is the right word, because there might be others in the world that exist like this, but it is different. So absolutely went in with the Brent permanent equity model. And I was fortunate. Awesome. He was helpful to me and advice and like pros and cons, do's and don'ts. So I went to early conversations with potential investors and I'm like, I want you to give me your money and we're never going to liquidate the portfolio because that doesn't make sense. And a lot of them agreed. Like some of these PE people that we're talking to were like, yeah, the worst part is that you have to sell your best assets.
The guys from the business.
To time the fund. Yeah. And they're like, that doesn't make sense. Why would any business owner sell their best asset that's performing with us? And I'm like, yeah, that doesn't make sense. Let's not do that. And as we talked with advisors, attorneys, investors, they're like, you kind of have to have a way for people to get their money back. So what we structured
kind of a thing, Kevin.
Life changes, and we've got some investors where this is their first legitimate
private investment or something.
Private investment, and I take that very seriously. And if that person, for whatever reason, needs their money back, we got to figure that out. So what we structured is effectively a 4-year hold period. I said we're going to try to deploy all this money in about 2 years, but I'm not beholden to that timeline. It's just that's how we size the fund. And then after the last check is written, that starts a 2-year clock. And during that 2-year window, you can have your money back, but you're going to take a severe haircut because that puts a burden on the fund. And,
you're doing things with it. Yeah.
Right. We're deploying the money and we've just spent all the money. So we can't just start handing people their money back. After that clock expires, so roughly 4 years from first investment, any investor can ask for a redemption of their capital. And we will establish a quarterly fair market value for the portfolio and just be transparent about that. And if an investor asks for their money back, SureSwift has first right of refusal to buy them out at that fair market value. Should we pass, it goes to the other investors in the fund. And should they pass on the fair market value, which is almost a 0% chance that
60 people or whatever the total is. I mean,
yeah. And a lot of people, they're like, here's some money. And if I had more, I would give you more. But I want to increase my share over time. So that very unlikely chance, but in the outside chance that nobody wants to buy that person out, they can go outside the fund and bring a new LP in. And drop some lingo, I'm the managing member of the fund, and I have discretion to, basically if they want to bring in a known terrorist or, drug dealer into the fund, I have the right to say no. But outside of that, like, sure, swap your money out at that fair market value. We're not going to have people trading above or below that because that hurts investors. But that's the process that we ended up defining over lots of discussion. And I feel like it's a really nice, healthy blend of permanent equity, long-term thinking, but people still can liquidate their investment at the timing of their choice.
I think it's so cool, Kevin, because the one thing that I try and get across in our training is even on the private equity, the amount of questions that you should ask someone, because think about what you just described. It's truly as creative as you want. So when I've said, if you've seen one private equity firm, you've seen one. Because think about what you just said. You're probably the only person that I've talked to that has some scenario like that. So
and I've heard you describe where are we in the fund life cycle, and how much have you invested, or what have you committed to LP? Those are all really smart questions if selling to private equity that one should ask. And then the answers aren't good or bad. You just need to know what you're signing up for. And for us, the answer, we just talked to a founder this morning who, the answer is, we're going to buy your company. We're going to keep the brand. In most cases, we're going to put your face on the website as hey, we own this, but this is the person that built it. And isn't he amazing? And, we're going to hold it indefinitely and hopefully grow it. And you move on to your next thing. We're going to celebrate that and promote your next thing. And, we've got this growing network of founders who have sold to us, who one guy has sold 2 businesses to us. And they now refer deals to us, and they, will take a call from a founder who's thinking about selling to us. And it's just this amazing network of people. And that may be true of other, these quote unquote proper private equity firms. I don't know, but that's just the way that we've chosen to structure it. And you're right. You need to know who you're selling to. And that's why, you and I agreed, selling price is one factor, but there are a whole lot of other factors that are equally important.
So, as you and I could keep going for a long time.
And I love it. We have.
So when you think about selling price is one thing, other than making some crazy monumental one takeaway, Kevin, we got a blend of listeners of a lot of current owners who have not sold yet or are thinking. A lot of people, I think, are thinking once they start to understand this, want to acquire acquire before they eventually sell. So there's both sides of the coin, but if you were to go back to the Kevin that's working at Cerner and say, hey, here are a couple things you should just really know as a philosophy or just fundamental knowledge, what would you have told yourself?
That is a really interesting question. And I have a couple of thoughts for and this wouldn't something I would tell myself, but as you're talking about your listeners as they're thinking through this, one thing that a lot of people know this, but one thing I share with founders who are thinking about selling is that as a seller, you're going to be tied to your business for the rest of your life, whether you own it or you don't. Whether simply it's on your LinkedIn profile, as you're introducing yourself in a business setting, you might be oh, I'm so-and-so, I just sold this business. And the reason that's important is that, this is a cliche, but the best deals are good for both parties. And a seller who just wants to squeeze every dollar out of the buyer and squeeze the best terms out of the buyer, you're creating friction in that relationship immediately. And a seller who is trying to time the market and sell at the peak, and they know that there's a problem, that a train coming down the tracks the other way that's about to hit them, the buyer's going to find that out, and that's going to not just create friction in the relationship, that's going to break it. And so that ongoing legacy where you're tied to your business, you've kind of ruined that. And so that's something that I think it's important for a seller to think about, is that you want the buyer to be hugely successful with your business after you're gone. And you want them to grow it. And you want to look back 5 years and be wow, it's doubled or it's tripled or it's quadrupled. And isn't that amazing? And not be resentful that somebody did that with your business. Because, just think of it you chose not to do that. So a little bit in the seller mindset that I have learned along the way is important. I think it's important for people to think about. for me, if I could go back and give myself one piece of advice, it would be to understand that businesses take on the personality of their founder for better and for worse. And I learned this the hard way. It's true of all, like me, my business has some of my personality in it, and hopefully my team complements me, and they're filling the flaws that I have. But especially solo bootstrap founders, the business takes on the personality of the founder. And the reason that's important is that I look back, and the biggest bombs of our acquisition history, the biggest mistakes, the biggest black eyes, each one of them, I think back, and that founder, there was something that didn't fit with me as a person or us as a company. Like one example, I hung up with the call, and the technical guy that was on the call with me, we're both like, something's off about that guy. Like, I can't put my finger on it. Now we have a term for it internally. We call it founder fit. Is that founder a fit for us and our core values? Would we hire that person to work with us if given the opportunity? If it's a yes, then okay, let's proceed. If it's a no, it's like red light, stop the assembly line, it's over. Yeah. Because we have learned the hard way. If there's something off about that founder, there's probably something off about their business and how they chose to grow it, or how they treated their team, or how they treated their customers, or the tech stack that they chose to implement, or whatever it is. We have learned that if the founder's a fit for us, then their business is probably more likely a fit for us too. And that doesn't mean you don't have to do all the due diligence and the other things aren't important, but that's one of those things that I never would have imagined that would be one of our kind of first 5 things that we review and kind of sign off on as a team for an acquisition, is that founder fit component.
So interesting, man. Like, I think about efficient markets. I mean, the privately held M&A space is the definition of inefficient, because the knowledge is not universal. And then it's really interesting when you just think about commerce in general, like people buying and selling stuff, it's all based on trust and an agreement on value. Like, I mean, if you have that, you can hand off assets and everybody's happy, right? Because the sellers choose to sell for a reason, given all the knowledge that they have, and buyers choose to buy. But the problem with this marketplace is not efficient. And so you're totally spot on. And it just comes down to that gut instinct. And whether you're a buyer and you want to buy a good asset, you're drooling over it because of how much cash you can make. And a seller, the same thing. And yet, sometimes you blind yourself with that trust just because you want the deal so bad.
Yeah. And another that reminds me of another issue in the market that I don't think would ever be solved for. But again, back to I love that you and others are helping to educate people on this process. A lot of the people that sell their business to us, they got one chance. Most people, our demographic skews pretty young. Yep. I would guess the average person we've acquired from is 32 years old, and they all have the next thing that they're planning to go do. But there's no guarantee that next thing is going to be as successful as the first thing. So they're sitting on one asset. They can make one sale and have a life-changing payday. And it terrifies people that they're going to screw it up. And nobody learns about this process, or you have to learn on your own through podcasts or books or whatever. And you still have this fear that you're going to screw something up. And then we're on the other side of the table, and we've done this 38 times, and it's not my one chance to get right or wrong. It's I really want to get it right, but if I miss something, it's not going to, screw up my net worth.
Life. Yeah.
And honestly, there's an information advantage and asymmetry there that we choose to flip on its head, and we choose to be a part of the education process. Chris, who's our VP of acquisitions, does a monthly webinar, just how our business is valued, with no expectation other than we'd like to have your email so we can send you the invite. No expectation you're going to sell to us. You don't have to tell us anything about your business. We're just trying to put good information out into the world and be helpful to people. And we try, the founder I mentioned this morning, he said at the end of our call, he's like, man, you've taken what is a very stressful process and made it a little bit less stressful just by the way that your team interacts, how transparent you are about the process, the fact that you've done this before. And so we try to take that asymmetry and not take advantage of it, because other people do. And that, again, back to that, we're tied to the founder for better and for worse. And so if we don't want people to try to take advantage of us based on what they know or time in the market. And, in a complement to that, I don't ever want to feel like a founder thinks they got taken advantage of by me or my team or the terms, because we knew better than they did. We snuck something past them. That's just not what we're about.
Well, I think it's interesting because that is the definition of an inefficient market, right? Of everything you just described. And like, it is better for the buyers too, because you want people with better advisors to better understand the deal structure that you're offering and say, hey, this is good. Because like, even if you did everything in your God-given ability to be transparent and truthful and honest and whatever, if they don't understand what you're offering, it still could blow up.
Right. And if I'm in a bidding against some, I like to say, we don't get into bidding wars. Like, this is our price, these are our terms. And if you can find something better from a better company, cool. I'm not, we don't necessarily like to play those games. And I don't know what the other firm or person is doing or offering or how they choose to treat people. I just we're us, we're going to do it our way. And I know there have been times where we didn't have the highest price, and I don't know what the terms were, but the seller just believed that ours was a better home for their business than the other person. And you're right. This is a very inefficient market. And when I got into it, it was even less efficient. There were literally podcasts telling people, yes, you can sell your bootstrap software business. It is a thing. There are buyers out there for it. Now, the world has evolved a lot in 5 years, and there are more professionals and more understanding and transparency about what is the value of a company. And this may sound weird, I wish there were more companies like SureSwift out there who are taking a healthy approach to it, doing it the right way, not just loading up with debt and buying one business to try to exit from their own corporate handcuffs, because that just, that rising tide lifts all the boats, and it makes this market being efficient is not bad for SureSwift. It just makes it's a healthy way of doing business and reduces friction.
It's only bad for the predators out there. So 2 final questions and we can wrap up. One is, what does the word intentional mean to you?
Like tying it back to the name of the podcast. I just, intentional meaning thoughtful and not hasty. And I'm fortunate that I've got a really, really amazing team that is able to handle the day-to-day of the business. And I get to spend as much of my time and mental energy in the future as possible, which just means I've got more and more time to be intentional about what we want to be as a company, who I want to be as a founder and CEO, what sort of life and culture do I want for my team, what sort of experience do I want for investors and for founders who sell to us, and for my team and for their families. And it's a more healthy way for me to live. And it's not like this is Kevin. I've evolved into this space because I kind of joke like I was a caveman figuring stuff out. I still feel like that a lot of days, but early SureSwift, it was a start. We were just figuring things out day by day, week by week. And I'm fortunate to have had more successes than failures and have this team. And so for me, I guess, to put it a little bit more succinctly, it's like living in the future, or putting my brain in the future and figuring out the path to get to that envisioned future.
Ooh, I like that. I like that a lot. What's the best place to get in touch with you, find more information, sign up for those webinars, whatever your normal handles are?
Yeah, SureSwiftCapital.com is the way to get on our email list and learn more about SureSwift. The webinars are front and center right there. The best way to connect with me is Twitter. I'm Kevin_McArdle, and McArdle only has one C, not two. I exist on other social media platforms like LinkedIn and Facebook, but I don't pay much attention to it. So yeah, find me on Twitter.
Kevin, thanks so much for coming on the show, man. This has been fun.
Yeah, Ryan, it's a pleasure. Glad to be with you.